Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate, from interest rates to the economy to what's happening in Washington that's unheard. Anything that's pertinent to helping you if you're a consumer making more educated real estate decisions, or if you're a real estate agent or anybody else out there in the finance industry. Hopefully we can bring some interesting light to many of the subjects that people don't want to touch in the national media. If you haven't done so already, many of you have downloaded our podcast on iTunes. If you haven't yet subscribed, that's an easier way, so they automatically will download to your device when there's a new one available, so you can do that. Also, if you'd like to leave us a review on iTunes or Stitcher for those using Android devices, please do that as well. Or if you're just listening right from your computer, you can obviously go to realestate360live.com. You can stream all the shows live there as well. And on the right-hand side, there's an Ask a Question button for any questions that you may have or anything that you may like for us to cover on future episodes. Joining me on our panel, as he does each and every week, is Louis Camarasana. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert. He's been cited in the news, Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you?
I'm doing well, sir. So, where we left off last week, not much has transpired over the last week. We were just joking before we came on that it's much of the same, right? We've got, obviously, we had a few reports coming in, and we'll touch on those. The big thing for this week, and obviously we can kind of dive deep into the Fed meeting that's going to take place on Wednesday. So on Wednesday, the Fed meet, they're going to give their quarterly forecast. They're also going to give their basically their policy moving forward. That's going to be the biggest thing, and it's going to probably dominate the news for the entire week. We'll probably see some posturing in the stock market and the bond market headed into that meeting. But before we dive into that, and I also wanted to bring up that we'll also touch on one of the new rules that's being implemented by the CFPB, which will basically render all pre-approvals useless. So many people that get pre-approval letters, you'll want to stay tuned if you're a consumer and actually finding out why these pre-approval letters are basically going to be worthless in the coming future, mainly because of a rule being implemented by the CFPB. But before we dive into those, retail sales have came out, and they were last week. February headline retail sales was negative 0.6% versus an estimated 0.4%. Now, this is, a drop now for 4 straight months, Louis?
Including the Christmas season, yes.
Yeah, including the Christmas season. And I think what's the most telling to me is that the media has been driving the whole, they're going to be on the way up. They're going to be on the way up because, look, gas prices are getting cheaper. People are going to have more discretionary income to start spending on other stuff, and that just hasn't been the case. And you talked about this on a prior episode, more about, people are kind of scared, and I feel like saving any money that they do have left over, or that money is going for just normal stuff like food and energy and other costs that have been rising, healthcare costs and everything else that's been going up over a period of time. They don't have money left over because I feel like at the end of the day, many people are running into the red after their paychecks come out. They're using everything they have there and probably tapping some on their credit cards and other means. So they wouldn't be inclined to continue to spend money on other goods and services, clothing, and all the other different things that people typically spend money when they have discretionary income. So the media has been hyping this recovery that we've had going on for years at this point. I think that the retail sales tells us pretty much all we really need to know. I want to get your take on the retail sales, Louis, and the thought that you and I both know that there never was a recovery, but this is what they pushed out there. And you had mentioned that there's a couple articles out there floating around that the media may start changing their tune because 4 months of straight negative sales is not a very good thing to hang your hat on when you want to continue to tout the recovery model.
Yeah, well, Ryan, our economy, the United States economy, is driven, and it's a function of a restructuring of the economy over the last 20, 30 years, is based on consumer spending. And consumer spending is based on availability of credit, and also, in the real world, the ability of people to take out credit because they can afford it, because they have a steady job, because they have rising income. So they can go and buy stuff that's imported because we've lost our manufacturing base. We've exported those jobs overseas. But supposedly the good news is now we don't have to work. We think they sweat. They send us their stuff. We send them the dollars, and the economy works. All right, that's not a good economy, a sustainable economy in the first place, to have things set up that way. But when it doesn't work, meaning that the people can't even produce, so to speak, meaning they can't even spend and play the role that they've been assigned as the person who sits around flush with credit and can go and buy cheap goods at the mall. If they can't do that, then where is the economy? Because if our economy is 70% based on consumer spending and the spending isn't there, and then they have to blame the weather and say it's unexpected, that weather excuse always disturbs me. One, because the weather doesn't have that much of an impact. If the U.S. consumer is so mighty and so robust, he knows how to get online and buy crap if he wants to. He can start ordering online. You know, if he really wanted to buy stuff, he could. But even worse than that is the unexpected. When they put out their forecast of what they think the number is going to be, they're calculating them right up to the last day before the number comes out. They know what the weather was.
Right.
So when it comes out poorly, they automatically blame the weather. They never want to look to the underlying reasons why people aren't spending money, even though, point to housing as you do each week, interest rates are very low. The economy isn't going anywhere because people don't have jobs, despite what the non-farm payroll says, which is all based on assumptions and birth-death assumptions and a survey that they send out. As you know, surveys can be manipulated. So the only economic data that we've had in the last 3 or 4 months that has been positive at all is that non-farm payroll number. Even the initial jobless claim number has been showing signs of increased initial jobless claims. But because the non-farm payroll number is the one that Wall Street rallies around, they claim to have shown job growth, and they seem to be ignoring industrial production being down, inventories being down, retail sales being down, home sales, new home permits, all being down. And so when will the media finally decide that the public has heard enough of this, doesn't believe it anymore, and stop using words like robust, strengthening, solid, accelerating, rate hikes, U.S. economy is doing better than the rest of the world? Because it's not. And there was a Bloomberg article I mentioned, Ryan, at the beginning when we were talking pre-show, that came out on the 13th, just a few days ago. And the headline is, "Surprise, U.S. economic data may have been the world's most disappointing. Is this a sign of unanticipated weakness in the economy?" So you see the setup there. Mm-hmm. Unanticipated. You and I, to us, it's not unanticipated. We've been watching this all along. Anybody else who's been paying attention doesn't think that these bad economic reports that have come out over the last few months are unanticipated or unexpected. But I think that's the narrative that they kind of want to throw back at us now. The official propaganda is now beginning. The data has been poor for months, so now this gives the Fed fodder to start backpedaling on interest rates. But this week, they're not going to backpedal this week. They're going to be as ambiguous as ever. They might remove that patient language. That doesn't mean they'll do anything in June, but they'll get everybody nervous that they will. Right. They'll start talking about it in June. And as we've said, they will probably, for credibility's sake, appear to be going towards the path of doing a rate hike, talking about a rate hike, and then possibly even doing the rate hike. But they'll stretch that out. You know, it'll be all year, and they'll have not raised rates since 2006, and it'll be 10 years, and so they've moved rates off of zero interest rates to a short-term 0.25. And then they'll start talking about the next one for the next 2 years. So they're not going to raise rates in any meaningful way that'll change this credit debt paradigm that we're in, where it's all based on cheap money. It's still cheap money if you have a short-term Fed interest rate at 0.25. So nothing's really going to change other than the perception that somehow the Fed is prudent and is, quote, normalizing interest rates because the prior emergency measures of QE worked, and now we've reached this escape velocity. But as the numbers come in and they're poor, and the Fed sees that they're poor, and the rest of the world sees that they're poor, and the media can no longer tout them as solid and robust, that's when they'll start talking about hoily, accalmaudative, mawnetree policy again. They'll stretch it out for credibility's sake because they want to give the ECB run room on their QE. The U.S. doesn't want to start theirs until the ECB has done theirs at least for almost a year.
Yep.
So that's where I see it happening. They'll stretch it out. The economy's not doing well, but they have to claim they've stopped because they did their job. Now it's the ECB's job. They'll do it. It all works. And that's the whole concept of this currency wars. When you hear that people say currency war is this and currency war is that, it's not currency wars. It's coordinated central bank manipulation of interest rates. They all want the same thing. They're not battling each other. Bank of Japan does their own stimulus, their own QE right after the U.S. starts. Then the vice chair of the Fed goes over to Europe and tells them, you got to do QE. They do it when the U.S. stops. They take turns. They're in a relay race of racing to debase their currencies because they all want the same thing, Ryan. Forget the trade aspect. Sure, there's a trade aspect. We're helping Europe right now because for years they had a strong euro. They couldn't export. Okay, so now the U.S. works out with them and says, we'll get the dollar strong. It helps us because we've had a lower dollar for 6 years. Now it's your turn to have the lower euro. But the real reason, I think, for this coordinated manipulation is all central banks have a debt problem. And you've mentioned this many times, Ryan. They cannot service their debt at higher interest rates. So while they're using this farce of a currency war, that somehow there's this battle going on when there's not, what their central banks are all trying to do is lower the cost of their sovereign debt loads and also to try to stimulate the economy through handing out cheap money.
Right.
So I don't think there's any currency war, so to speak, and I think they're going to use that when it all falls apart, that somehow there was this battle going on, and that's what caused the collapse, when it's not. The Bank of Japan, the Bank of England, the ECB, European Central Bank, the Fed, the Swiss National Bank, the Danish National Bank, they're all working together to manipulate interest rates. And they're not working to manipulate them higher. They're all trying to keep their currencies low. That's what the whole Swiss National Bank thing was about, depegging. They were trying to keep the Swiss franc low. The Danish kroner is trying to keep the Danish kroner low. The Fed, through QE, was debasing the currency. ECB is debasing the currency. Bank of Japan is debasing the currency. So this concept that they're warring with each other, they're not. They're working together in a way that in history really hasn't happened before. So perhaps in the past there might have been currency wars where banks kind of worked independent of each other. But right now, Ryan, do you think that all those banks that I mentioned are warring with each other, or do you think they're heading towards the same goal of a zero interest rate and even a negative interest rate policy?
Of course they are. And, it's interesting because the Fed has basically perfected the model of avert a crisis and create this illusion that everything is fine for an extended period of time and get everybody believing the hype. The Wizard of Oz is here, and you know what I mean? And that everything is going to move in the right direction. We have 6 years of this nonsense. The Fed could write the white paper for the way to avert a crisis and continue to print money and do whatever you want and allow the public, because you have a higher stock market, to have the perception that everything is on the right track. Every other country can take the same model, but you do bring up the point that I talk about all the time, which is that the reality is that all these countries' governments have large and unsustainable debt loads, right?
And increasing debt loads.
And increasing. And
they've dug themselves holes so deep. The old proverb, when you find yourself in a hole, you stop digging. That's not going to help. They have to keep digging.
Right. Well, and they can't afford to pay higher interest rates. They can talk about it all they want. And could the Fed everything that the Fed does at this point is just for credibility. That's it. If they realize the one time that they screwed that up and how bad of an impact it had on the market, where they kind of told the market one thing and did another. They can't do that anymore. They have to kind of always tip their hat. Now, Fed meeting on Wednesday, Yellen's going to, trot out on her horse and probably say many people are projecting her to take one word in the entire thing and strip it out. What's the one word? Eliminate the word patience, right? Patience, that they're going to be patient as far as not raising interest rates, right? They're just going to remove the word so that it might signal to the market, signal to everyone else around the world that maybe 2 months from now that they potentially could raise the federal fund rate by 0.25%. Whoop-de-doo, 0.25%. What does it matter? Now, I don't believe that they will raise it 0.25%, but they could. They could for the simple fact to say, look, we're in control of this. We're still moving in the right direction. Although I know the numbers don't show exactly where we want them to be, we're going to make the move because we feel that it's the right thing to do, right? They could just do it just to say that, we feel like the economy is really improving. I don't think that it's going to happen. I don't think that it's going to happen through the end of this year because I think that overall they know that raising interest rates is going to have a negative impact. And it's actually going to have an impact, like I said, of just for the government being able to pay back, pay interest on that debt. But you and I had talked all the time, Louis, that they're very clever in doing things to give a perception that things are either better or worse than what they really are. But
right.
It's mainly better. They always have been hyping that everything is getting better. We have inflation. The headline PPI number was negative 0.5% versus an estimated 0.3%, right? And when you stripped out food and energy, it was still taking 0.5% on a month-over-month basis. Now, we have a deflationary environment, but yet they're saying we can't have deflation. The economy is growing at 2 to 3%.
And they love inflation. They have an inflation target of 2%. They supposedly think deflation is the worst thing. So why, if you're just thinking the way they do, I think it's fine that the prices are coming down. I welcome that. But they don't. So why would they be talking about raising rates other than to stick to the fake narrative that their economy and what they wanted to happen in the economy is happening when the numbers indicate they're not? If they have deflation, they failed. They printed $4 trillion, and their own made-up numbers don't jibe with somehow they're getting closer to the 2% inflation. Well, it's going to get there. Again, the only number that seems to be headed in the right direction is the non-farm payroll number that comes out once a month. And that sustains the market, and it sustains the narrative that things are solid, robust, strengthening, and an indication of things consistent with the second quarter being better than last year. And it never turns out to be the case.
Right. I mean, and think about this. So anybody that thinks that they're going to raise rates come June, there's a bunch of reasons why it wouldn't make sense. I mean, number one, like as you mentioned, Louis, the rest of the world is lowering rates right now, right?
Furiously. They're negative.
So, yeah, they're going negative. Why would we want to? And then another one would be the dollar would continue to fall if they do that.
Continue to rise, you mean?
Sorry, the dollar would rise. And you also have the fact that everybody knows, and like the rhetoric was started in the media, that the economy is soft, even though they've said that it's been robust and all these things. I think the reality is that many people are catching on that it is soft, and we don't have retail sales up, we don't have housing permits up, we don't have housing starts up, we don't have penny sales up, we don't have all the things that should be up and should be up huge. I'm talking.
Right.
I'm talking
not just missing it. It's not just that they're missing expectations. The expectations are already lowered, and they're looking for something flat or slightly above flat, and they're negative.
Yeah, I'm looking for something that is just it blows the number so far out of the water.
Right.
That's what should be taking place. We have a stock market at all-time high levels. We have interest rates at all-time low levels. We've got great economy. We've got non-farm payrolls moving in the right direction. Where in the heck is all this robust?
It's in the stock market, it's in the non-farm payroll from the Bureau of Lying Statistics, and it's in the propaganda that the media spits out. But even their own numbers, all the other numbers, industrial production, you went through the whole litany of them, none of them are any good. And they're not even going in the right direction.
It is literally, we're at the point that I don't even know, I sometimes can't think of how to even put these things into words, and how I feel that they've brainwashed everybody.
Totally. Well, you know why, Ryan? It's about confidence. It's all about confidence ever since the dollar's been taken off the gold standard. And the one thing that gave the world confidence was that the Fed would raise rates if they had to, and they did that in 1980-81 with Volcker. And then what gave the people confidence was, since 87, if anything went wrong, the Fed would come riding to the rescue with the Greenspan put. So one thing that is sure, that doesn't necessarily underpin the dollar, but it definitely underpins the stock market. You know, there were periods of time before 1987, like in the 60s and 70s, the stock market went absolutely nowhere. But since 87, it is a blip. They will come riding to the rescue, long-term capital management, bailouts in 2008. No matter what it is, the Fed has believed that the stock market is the trickle-down way of pushing the economy. And there's a reason for that, because they're owned by the banks that benefit from Wall Street robustness. Mm-hmm. And so they need people to be confident not in the economy. They need people to be confident in the Fed. They need people to be confident in the stock market, even though most people don't have enough money to have money in the stock market other than the money that they have pulled out of their paycheck and sent to their 401k plans. And that's why the central banks themselves engage in stock futures buying. And the excuse that the CME group gives as to why they have special discounts for the central banks and why they're in there, they say, well, they provide needed liquidity. As if the stock market isn't big enough, you need central banks in there manipulating the price always higher?
Yeah.
It's crazy.
Well, and, you know, it was interesting. I was at
one more thing. And the reason they get away with all this is, there was just a survey out the other day. I think it's like 80-90% of the people don't even know who Janet Yellen is. Well, that's fine. They don't really want people to know who she is. And when she gives those little talks, they don't want people to really look at it and say, what's going on? When people hear about Janet Yellen or the Fed, it's usually just some headline, things are good, Fed lowered rates, Fed this, but there's no analysis, and they don't want analysis on that.
She's really not worthy of talking about. She hasn't said anything really noteworthy. She comes out, she's more of a puppet than anything else.
Sure, but her role, though, Ryan, is far more important to people's everyday lives and their financial health than the stuff that people actually pay attention to.
Yeah, and
people don't know enough to know that she's not relevant.
I agree with you 100%. That's what I was saying. I was at one of my son's birthday parties this weekend, one of his friends, and interesting because, like, conversation always pops up somehow about, like, stock market or one of these things. And I just kind of listen in on the conversation and listen to what people say. And it's just, you know, sometimes people actually do know a little bit. They talk a little bit about, you know, companies buying back their own stock, propping up the stock prices and all that. And at the end of the day, I'm just like, yeah, but I was like, but there's really no profitability. I mean, true profitability of these companies is just an effort to you know, continue to prop up stock prices of companies that aren't really making any money. And, you know, we can show countless companies, Radio Shack and all these other ones that have been around for years and years and going out of business. And the ones that are thriving right now are the ones that aren't really making any money. And we always bring up like Zillow and Trulia and many of the other internet sites that just get eyeballs on web pages. They're selling advertising back to real estate agents and others. And they're not showing any profit in the last 10 to 15 years, but somehow their stock prices and market caps are through the roof.
Astounding that Zillow still has a market cap and people still believe it's going to this and it's going to that. It's gone nowhere for over 10 years, has made no money. And it's in a market that really has no prospects for volume sales. Because Zillow doesn't make more money if the prices of homes go higher. It would only make money if there were more real estate agents making more money and doing more transactions.
Yes.
And that's not happening. But yet it has a market cap. And now, you know, we mentioned they bought Trulia, so that gives them another year or two to work out the kinks there and to tell everybody that the synergies are there and they're working on them. And, you know, there'll be a pro forma and they won't be able to do, like, for example, they just came out with their quarterly report, and they showed a big gap loss. Oh, well, that's because of the acquisition cost. Yeah, but even without the acquisition cost, they still lost money. So when are they going to reach this period or this plateau where now they have all the traffic and they have the name recognition, they're going to start making money? Well, they already have it. Mm-hmm. It just shows that the business model doesn't work, but yet that doesn't seem to concern Wall Street because they just bid the price higher. Yeah, and as long as they can keep bidding the price higher and telling the story, more people will buy it. It has nothing to do with the fundamentals, just like the rest of the economy.
Well, contrast that, Lewis, with a small local blog that basically doesn't really have any overhead, that puts out real estate news, gives information to the consumer, helps them make educated, informed decisions. They do the same advertising, affiliate links, and all the other things, and they bring in revenue of $10, $20, $30, $40, $50,000 a month. They actually have net profits at the end of the year. They make $500,000 a year. That sounds like a pretty good business. Would you agree?
Yeah, but you can't go public on that.
You can't, and you know,
because there's no revenue growth. You may have profit, but you can't. You can show that it's going to grow. Like Zillow, you think about it. How can a company have turnover of $380 million a year and not make any money? Well, simple. Most of it they buy.
Yep.
I mean, if you're willing to lose money, I can turn over $300 million. Give me $400 million. No, seriously, that's exactly how you do it. You buy, you get more, you hire more salespeople, and you have them sell more. Even if the cost of sale is higher than what you got, you can always say, yeah, but it's, we got a customer now, we're going to grow that customer. No, he turns out in 3 months. So you didn't grow anything. But you grew your revenue, and you can continue to do that. As long as Wall Street is willing to pay for revenue growth and not profit, and you can tell them what the profits are coming, they're satisfied.
Well, and it's interesting because I use a real estate platform, and I'm not going to disclose which one it is because I don't want there to be any pushback on this. That basically provides leads, right? And it's tied into Google and Google AdWords and things like that, and it's a way for people to search for properties. And you get buyer leads in, you get seller leads in. It has back-end capabilities and all these things. It's been a small company, but it's one of the fastest-growing companies that have been out there. Well, just last week they basically came out, and now all of a sudden they're getting private funding. Okay, what does that mean? Well, to me, it means that they weren't growing revenues fast enough, right, Lewis, like you said.
Right.
And they now are getting private funding, which means that they're on their way to probably trying to be another one of these publicly traded companies at some point.
Or to sell to
one of the big guys. Exactly. But you know what happens?
You know what they're going to do? Your lead quality will go down because they're going to try to send you more leads. They're going to try to get more leads from more people. They're going to lower the lead quality, but they're going to increase the number of leads that they can sell. They'll sell more. Their churn rate will go up, but overall they'll have higher revenues.
Yeah, and you know what? As soon as you're getting financing from somebody else, the expectations change. It's no longer, you're just making decisions for your company. I mean, you can say you're an all you want, but
no, because that guy who owns that company, he wants to make profit so he can feed his family, pay his mortgage, and so on. But if someone else he's already getting equity, and he realizes that he can make more money through boosting the equity value. And it used to be that there was a correlation between equity value and value, meaning if you produce value, then your equity will go up. Now you can get equity value to go up even if you undermine your company, not just through buying back your shares instead of investing in your company and hiring people. But if you actually do things like grow revenue at the expense of profits, that doesn't seem to matter. That would matter if you own the company because then you wouldn't be making any money. But Wall Street seems to think, or pretends to think, that when you grow revenue at the expense of profits, you're actually, playing it forward and you're growing for the future. And if there's revenue growth, the profits will come. And even if they don't come by then, the people that invested right now in this company, they'll be long gone. They'll have sold out, in a year or two, and he'll still be selling that story about revenue growth 3 years from now. And they probably still have it because once you get private financing, now you can go out and hire salespeople. You can haul them up and you can generate more revenue.
Well, I always tell people, have you seen the show, The Shark Tank, Lewis?
I've heard about it. I think I've seen one or two shows where the guy gets up there and he tries to sell his idea.
Well, and I tell people all the time, okay, so the premise of the show is great because the sharks on the other side are venture capitalists, right? And they're trying to determine whether they're going to invest in somebody's company. And I always say to people, well, just do the Shark Tank test on a company, and if it works there, then it might make sense for maybe a stock or something that you might want to buy, right? And the first question they ask them is okay, what are your revenues? Okay, what's the next question? What are your margins? Right? They don't care if you're pulling in $3 or $4 or $5 million. If you don't have like a 50% margin or something, they don't want anything to do with your company.
Yeah, those are gross margins, though. You see, that what they do is they figure.
Well, they ask gross and then they ask net.
Sure, but I think though what happens is it's definitely for sure that when venture capitalists actually make an investment, they pretend, or the projections are, that the spread between the gross and the net margin is going to shrink because they'll show them in their business plan that that's what's going to happen. But what the VCs are most interested in is the prospect of revenue growth and gross margins, because they figure they can always fiddle with the other stuff later, and they never do.
Oh, of course they do. But they still, my point is that at the beginning of any company, you still should have to show that you're actually making money, right? In order for somebody to want to invest in it. No,
they go public, Ryan. The venture capitalists invest way before the company makes money. They now go public. I think 45-50% of the companies last year that went public were not profitable. That's crazy. You're asking the public to put money into something that's not proven. Well, Zillow's been public for 4 or 5 years now. It's not profitable yet. You wouldn't have lost any money if you bought in the IPO. You wouldn't have lost money at all other than if you bought during the IPO, the merger hype with Truly and Zillow, but for the most part, Zillow's gone straight up. You could have bought at any point over the last 4 or 5 years and made money, even though the company hasn't.
Well, and some of the companies that were on the Shark Tank were actually profitable companies, and the sharks were asking them, actually, why are you here? Because it doesn't seem like you need the money. You've got cash flows, you've got excess capital. Why are you here? Like, what do you want? Well, what they want is they want for their name and brand recognition to take them to a higher place, which, as you mentioned, be acquired by somebody else, right? Or be able to become a publicly traded company and flush them with even more cash. And so,
but they can't get bank funding. That's probably the reason too.
Well, of course, and as you grow, what are the problems that you have, right? It's cash flow problems typically, and banks aren't willing to lend. They're not. And this is what I deal with on pretty much a daily basis. Small business owners, and they're all asking me, like, who would you go to if I wanted a small business loan? And I'm like, good luck. Good luck. I always tell people, unfortunately, you're better off to ask your friends, family members who have money to see if they're
right.
in actually loaning you money for your company and give them some sort of equity position in your company. You have a better shot with that than you do going to the bank, because the bank, unless you can show cash flow and you got tax returns to back this stuff up, it's not like Wall Street. They could care less. If you don't
right, but once you have what the amount of cash flow and the resources that a bank would approve, you probably don't need the bank, as the astute VC mentioned. Like, what are you doing here? Well, you can self-fund if you're at a certain point.
Right. I mean, there's, anybody will give you money when you have basically accounts receivables that are in excess. You know what I mean?
Right.
You see all the advertisements now that are like, are you doing $100,000 a year or more? We'll lend you $200,000 tomorrow. And it's pretty much true, because what they'll do is they can tie right into your credit card company and siphon off money for every transaction that comes through to make sure that they get paid. But people can't. I see every day these businesses that want to grow that just have a capital problem, and I tell them, I'm like, well, you need to go try and borrow this money from somebody you know versus going to the bank, because they're going to run you through. I'm telling you, it's going to be 3 years tax returns. They're going to want business plans. They're going to want P&Ls. They're going to want all this. And by the time you're done with it, you're going to be so worn out that you're going to say it's not even worth it. And most of the time it's not. Or so you go in for a $200,000 loan and they give you $10,000. I mean, that's the reality. That's the reality of where we're at.
Unbelievable. And in a growing economy, you would think People will be starting businesses left and right. And most businesses would succeed in this economy because consumers are flush with cash. There was investment. There's production. People can start businesses. And if you're a bank, sure, let's lend to businesses because the economy is growing. That's when you would lend to businesses.
Right.
When at this point in the economy, it's robust. Hey, this guy's got a business. Let's help it get it off the ground because the economic environment is suitable and conducive to good business. So let's lend. That's not happening.
No, they'd rather invest in the stock market. And
of course.
I mean, the fact that they're, like I said, we brought this up on another show. The fact that they're allowed to do that is it's terrible. I mean, there's no other word for it. You shouldn't be allowed to do that.
There's some expletives.
Yeah, there definitely are. And I mean, if the Fed truly wanted for the economy to turn around, like I said, then they would mandate the banks for the access to cheap capital, that so much of that money must be passed down to...
Right. If you're going to do central planning, don't just pay off your own guys, pay everybody.
We drop bags of cash over in the Middle East all the time. Why can't they just drop bags of cash off in the middle of the streets here in the United States? Why not? Why can't they do that? I don't understand. You know what I mean? Like, if you really want some money to pour back in, people to spend money,
right,
drop some bags of cash off. I mean,
they want control, just like anybody. When you hand out cash, you hand it out to the people you know, the people you like, the people who are going to do you favors. Why would they want to give money to you and me?
You remember the one year when they gave that rebate back of like $3,000 when you did your taxes or something? It was just free money. I honestly, like, if I were to run for president, I'd be like, you know what? I'm going to give everybody automatic $50,000 raise. Next year, we're going to send you a check $50,000. All your benefits will go up by 50%. You know what? Your mortgage, we're going to give it to you, but if you lose your job, you don't have to pay it back. Your student loans, don't worry about them. We got them covered. I mean, I'd win in a landslide. I'd have to.
No, absolutely.
But that's literally what we're coming to these days.
Well, what you do is, before you even offer more stuff, you guarantee with the people that already got stuff, they're going to get it. And they're going to get more. And if you're not getting anything, you're going to get some stuff too. Surefire way of winning. And that's the problem with democracy. They say once the people realize they can vote themselves a raise, it's over. It collapses.
Well,
I mean, it's as simple as once 51% of the population realizes they make less than the other 49%, all they have to do is vote to take it from them.
That's pretty much what's happened.
Right.
Yeah.
And so what the ultra-rich do is they throw stuff out there to protect themselves, and everybody else battling amongst themselves over tax rates and everything else when they don't pay anything.
No. They give themselves a $100,000 a year salary.
It's like Buffett. Then he goes and complains that he pays less taxes than his secretary. Stop. Mm-hmm. By the way, I mean, Buffett he has got a tax dispute where he owes billions for Berkshire Hathaway. But, of course, his argument there is, well, I've got a fiduciary responsibility not to, pay that tax if I don't think I have to pay it. And he's right. But then he has a fiduciary duty to shut his mouth, popping off about how the tax system doesn't work properly.
Yeah.
And he's talking out of both sides of his mouth.
Well, of course, because there's a political interest there, right? I mean,
well, sure, he got bailed out. I mean, Berkshire Hathaway, it's a fact, would have gone out of business if there wasn't the bailout. And he wrote that disgusting thank you letter in 2010, but how wonderful the government is. Now, that tells you right there that in order to be successful or to maintain your success, it pays to have the government, the Fed, on your side. So what signal does that give to anybody else who wants to start a business? You don't really have a shot.
Right. Well, it is.
And that's discouraging. That's not what the United States was supposed to be about. Opportunity, not about an oligopoly that controls everything, and that half the GDP is based on, or 70% is based on spending, and then the people that make the money, 50% of it's probably in financial services, of which we don't get any other than paying bank fees. And what financial services do you get? Yeah. I mean, if financial services are 40% of the economy, how are we benefiting? We get better banking. We get free checking. They give us loans. No.
Have you walked into a local bank lately?
I try not to. I try not even to go to the ATM.
It's a painful experience. I promise you, every time that I go into one, I'm just like, you've got to be kidding me. Like, I have to listen to this. There's always somebody arguing with somebody, first off.
Oh, really?
Oh, yeah. Every time I go in there, it's a customer just upset. They don't, like, somebody's putting hold on somebody's money. They can't cash a check for some reason because there's a 3-day hold on the first portion of that check, and then the remainder of that money will be 5 days later. And they've got all these machines now because they're trying to do away with people. They don't want people to have jobs anymore. They want to outsource it to machines, and then there can be a person behind it in India. But this is the model, is that these banks want contract employees just like everybody else does, right? And they're going to try to cut costs wherever they can. And the banking model is terrible, and they're charging more and more fees.
I pay for my business account. I think it's $14, $18 for nothing, just to have it.
And why should you pay? They think just because you're a business that you should have to pay a fee, right?
Yeah, no, and my other account doesn't have the fee.
Of course it doesn't, because you're a business, and businesses pay fees, not personally. You shouldn't have to pay one personally.
Yeah, so I can write it off on my taxes as an expense, so I don't challenge it.
And everybody's like, well, that's crazy. I thought, there's a few banks, there's a few local banks. That's why I tell people, go to your local small banks. There's a lot of those will have fees or no fees at all.
That is true. That is definitely true on me. It's the Bank of America and the Chase. They're the ones who charge you the fees. The local banks and the credit unions don't have those fees.
But
they want your money. They're trying to get your business.
Yeah, but the interesting part about those big banks is that everybody seems to feel like that they're the safest, right? And that's why they want to bank with them, is because if anything happens, hey, there's no way that Bank of America is going down. And you know what? There is actually a lot of truth to that, because if anything happens, Chase, Bank of America.
It's the one most likely for something to happen to, but it's also the one most likely to get picked up.
To get bailed out all over again. Right, yeah. And so they can get away with doing the ticky-tack fees that they have, overdraft fees, everything else that they have going on there.
You know what they'll do, though? They'll get rid of those fees if you open up, like, the brokerage account with them, because they want to put in the stock market so they can get some trading commissions.
Yeah, the banking world has changed, like I said, and I see it on a daily basis, because people come in to ask me who they should get loans through, and who's better than who, and it's a crapshoot at this point. But for the most part, I tell people, if you are part of a credit union or a smaller bank, you have a better chance. Which, kind of moving along, I wanted to jump into this rule that is being implemented by the CFPB. So, essentially, they did this study that they basically said that people aren't shopping for a mortgage. Like, they're going to like one company and they're not really shopping, and they feel that that's a bad thing, that people aren't shopping around for a mortgage. Okay, so we know how essentially now you can go to a bank and get a pre-approval letter for a mortgage, and you don't even have to provide all of your income documentation up front in order to get that pre-approval letter. So, Louis, you walk into Bank of America. They ask you how much money you make. You say $1 million. They don't even ask you for your W-2s, your tax returns. They just put that in the system. They issue you a pre-approval letter that's essentially contingent upon you getting all the income docs at a later time, right? Mm-hmm. So you get a pre-approval letter. Now you're armed and dangerous. You can go out there and write a contract on a house. Well, it makes sense, except for you now get under contract, and then now you go back to Bank of America. They say, hey, well, now we need you to show your supporting documentation for all this information. And you
that $1 million, that was over my lifetime over the last 30 years.
Yeah, you only make $50, and you no longer qualify. So how things are going now. And one would think that they would say, okay, you must collect income documentation before you could issue a pre-approval letter, but that's not the way it works. Well, the CFPB is going to basically come out and now say that you have to issue a pre-approval letter, meaning you have to send out loan disclosures and you have to issue a pre-approval letter before you can even ask for the income documents. Now,
how does that work?
You have to basically give a person a pre-approval, so you have to take down all their information. You would issue it just like they're doing now, the pre-approval, but you can't even ask for their income documents until after you issue that pre-approval letter. So it's essentially the same thing that's going on, but now that they want a rule that states this. See, most people, the credible lenders now would ask for all these income documents up front before they actually issue that pre-approval letter. Most of the big banks don't. But a lot of the credible lenders, they would say, okay, part of my pre-approval process is I want your tax returns, W-2s, everything, so I can go ahead and run it through the system and make sure you're pre-approved before I issue a pre-approval, right?
Right.
TFPB is basically stating that these pre-approval letters have to be given out before any income documents can be taken. So it's similar to what has been taking place, except now there's actually a rule on it, and they think that this rule is actually going to help people go and shop for a mortgage because they're not going to have to give income documents to 3 or 4 different companies.
Well, it'll boost the number of people that are shopping, but it won't boost the number of the people that are actually buying.
Of course. And once again, it's another useless rule that they think is going to help the consumer. This is the Consumer Financial Protection Bureau, right, the CFPB. So all they're trying to do is protect the consumer. So they feel like going and shopping for a mortgage is a way to protect the consumer. What's interesting is that they did a study that said that they weren't shopping, and many of the people are like, well, it's a painful process to go through the pre-approval process. Do you not agree, Louis? Like, it's not an easy process. Nobody wants to have to go through that 3 or 4 times. Nobody. So they probably only want to go to one person if they can. And I think that, I would have thought that a better rule would have been you can't issue a pre-approval letter unless you have all the income documents, right?
That would make sense.
Wouldn't that make sense? Then you would actually have people that actually are qualified for a mortgage before they go and write a contract. I would think that would probably be the smarter way to do things, because then you wouldn't have people actually going out and writing contracts and potentially putting their earnest money deposit at risk, right? Potentially, banking on them buying a house and telling their landlord that they're going to be out in 30 days, and then all of a sudden they get denied a loan and they can't move. I mean, wouldn't that be protecting the consumer?
You would think.
You would think. But it's
no,
never
the protection is it's almost psychological to make you feel better rather than to actually put you in a better financial position and actually protect you.
Well, of course it is, because nobody wants to be denied for a loan, right? So if they don't actually pull your credit, or they just take your information over the phone, Louis, how's your credit? Oh, it's excellent. Oh, how much money do you make? $1 million. How much money do you have saved up? $100,000. Okay, great. So you should be approved for $500,000. I'm going to send you over that pre-approval letter here in 15 minutes. And then 30 days later, after you're under contract, oh, your credit score is 500. Your income tax returns only show you make $50,000. I'm sorry, Louis, you're denied. Oh, great.
How did that help to go through that?
Of course, it doesn't help at all. But the reality is that these pre-approval letters mean absolutely nothing. Which in the real estate world, and see, as a real estate agent myself, I look at them all the time, and I typically call the loan officer and say, have you pulled credit? Have you collected the income documents, the tax returns, the W-2s, and everything? If they say no, that's a red flag. It's a red flag. So I have a pre-approval in hand that means nothing, essentially, right?
Pre-approval. It's basically anyone can get it.
Yeah, and I always tell people, you want an actual loan approval letter. Now,
right.
Some lenders will do this and some lenders won't, but I always tell people to ask. You want to ask them for a loan approval with a TBD address, a to-be-determined address, so you don't have to physically put one in there. But you could put in like the ballpark sales price of a house that you're looking for. So let's say it's $500,000. You put $500,000 in there. You get all the income documentation, everything else that you need into that lender. It goes to the underwriter to underwrite the loan for credit only, not the property, because there's not yet a property. So you wouldn't have an appraisal in there or anything else. But they get
because they can always deny it based on the property you're trying to buy.
Of course, but they can fully credit approve that person on a TBD address. If they get approved credit only, guess what? That's a very strong approval letter that they should be able to issue at that point, because all they're waiting at that point is to have a property. As long as there's no issues with an appraisal or things on the inside that appraiser may note of deficiencies with the property, then you're more than likely going to get that loan. So those are what people should be doing, but I don't think most people understand that. And it's very confusing out there in the lending world for people to understand. Oh, well, I just got pre-approved for $500,000, and I hate to tell them, but it doesn't mean anything. You know? I could call up a bank right now and get approved for a $2 million loan, but it doesn't mean anything. I probably won't get it. But you can be pre-approved for virtually anything because if they're basing the majority of it on what you tell them. And as I found out over the years, buyers are typically liars, but not sometimes intentionally. If they're self-employed and they think they make $400,000 because those are their revenues, but they write off $350,000, they only truly make $50,000, right?
Right.
So, but they don't look at it that way. They look at how much money they made as a business versus what their adjusted gross income is on their tax returns, which is what the lender's going to use. So, I say all this because I want people to really understand the point here, especially if you're out there shopping for mortgages at this point in time, that a pre-approval is basically useless. And if you're the consumer, then you actually need to push the issue on the lender. Like, hey, I want you to have my tax returns, my W-2s, bank statements, pay stubs, all of it. I need to get you all of it. I don't want you to give me a pre-approval based upon what I'm telling you. I want you to give me an approval based on what I'm showing you.
Yeah, but for most people, they don't have anything to show.
Correct. But I know that I would want, and I tell people all the time, I want peace of mind knowing that this is like set in stone. I don't want there to be, the potential for stuff to fall apart. All the clients that I work with, I tell them that, hey, you need to get all your documents in ahead of time. I don't want there to be, anything that could come back in the middle of a transaction that could, now, there could still be stuff that comes back. Don't get me wrong. But you're setting yourself up for success if you take these proper steps. And it's the same thing as I told you before, Lewis. If you're planning on buying a house 2 years from now, there's nothing wrong with starting your home process right now. Even if you don't plan on buying for 2 years, you should probably still go through the process now.
And what can you go through for the listeners what some of those things are to go through?
Okay, so what you're going to do is like, let's just say you have a local bank or credit union or lender that you work with. You call them up, you say, look, we're planning on buying in 1 to 2 years, and we want to kind of see where we stand, and we want to see what we can get pre-approved for right now. Call them up. They're going to basically send, get all your information. You're probably going to send them all your income documentation like I told you. They're going to pull your credit. Okay? Mm-hmm. Now, why is that important? Because if you have a 500 credit score, you're probably not buying in the next year or two.
Or you find something on there that would make your credit score go higher if you can get it removed.
Correct. So you might find that there's some inaccuracy on your credit report that you could fix, or
that takes time to fix too.
It does. It takes months typically, and it's not years. And if you have a 680 credit score, and guess what? There's a break in interest rates. If you have a 720 credit score, then guess what? Over the next 6 to 12 months, you can probably do certain things to your credit, pay down your balances of your credit card, get rid of a collection that you didn't even know was on there, to get your credit score higher to a 720, so you're paying a lower interest rate a year from now. You find out what you're going to be qualified for and what the payment is on that type of sales price right now. The reason why you want to find out right now is because everybody says their timetable is a year or two down the road. Whenever I talk to people, we're not ready to buy right yet. Well, why aren't you ready to buy right yet? Most of it is because they don't know where they stand, right? And when people are scared, they don't typically investigate.
People don't look at their stock portfolio when it's going down. They check it every 5 minutes on the way up.
Yeah, and if people think they have bad credit, do you think they want to check it? No, they don't. And I know this from dealing with hundreds and hundreds of people. It's burying your head in the sand is the easiest thing to do until you're like forced that, okay, now you have to buy or rent, now you have to look at it. And I'm telling people the opposite. Do it now. If it's a year or 2, 3 years down the road, I don't care. Just find out where you stand. And a lot of people, what they end up finding out is today, with low interest rate environment, a lot of people could qualify right now today for a program that they may not have even known existed. And it may make sense for those to buy today versus 2 years from now, because of the cost of home ownership is at an all-time low if they can afford it. But without finding out where you stand today, it's really irrelevant whether you plan to buy a year or two down the road. You need to know what you're dealing with. And I think that one of the biggest reasons why we have such high rate of loan fallout, meaning denials, when people getting denied, it's just because they're not taking the proper steps. I think if you take the proper steps, it's okay. You know what? Don't look at being denied for a loan as a bad thing. Guess what? Most people are. Just in the same thing for the small business loans that are out there. Most people aren't getting them, right? Don't look at it as a bad thing. Look at it as a good thing that you're being proactive, finding out what the lender wants, even if you get denied, and you have time to fix those things.
Right.
You know, you have time to maybe save some more money for a down payment. You have time to pay off a few medical collections that you didn't know existed, or pay down balances of credit cards instead of 100% of the high credit limit to get them down to 25 or 30% of the high credit limit. You know, there's a lot of things that you can do, and over a year period of time, get your credit score up 100 plus points. But it all starts, you know, to me, with being an educated consumer. Don't think that the banks are smarter than you, because most of them aren't.
What does that mean?
It means that the people that are inputting the data in the computer are just robots. They're robots. They are not educated. Remember, if you work for a bank, basically you fall under the banking license. Like, they don't have to go out and get an independent mortgage license, a loan officer license, like you do for many of the other mortgage licenses. If you fall under a banking license, then you just have to take some continuing education. You get this basically license for nothing. You don't even have to pass a test. Okay? So you sit behind the computer screen comes up name, date of birth, social, income. They punch all these things out, and the computer spits back the approval. They're not really trained on how to review income documents, to look at pay stubs, look at bank statements, do all these things. They're not. So I would caution people when you walk in to get a pre-approval letter, especially from a large bank, and I'm not singling them out, but Bank of America, Capital One, JP Morgan Chase, Wells Fargo, they're all huge, okay? They're robots here. Do you think that they're paying these professionals a lot of money? No. 15, 20 grand with probably some commission, versus going to maybe a local lender that did have to get a license, that had to, you know, do all these things, that understand collecting documents. It's probably the better way to go. Now, will the banks sometimes be more competitive on rates? Yes. But to me, it doesn't mean anything if you can't get the loan approved.
Exactly.
They can promise you 3.5, and then a local lender can say 3.75, but the loan probably may not go through with the big banks. So they can promise you the world, but at the end of the day, to me, it's more important to actually work with somebody that is actually going to get something accomplished. And like I said, I don't mean this to say that all big banks are, that there's probably some great loan officers that do work for some of these bigger banks, but for the most part, most of the bad deals that fall apart, they come from just a lack of preparation in the beginning, and the bank's not being smart enough to get enough information from the customer up front. So if anything else, guys, just be proactive. I don't care if you're buying a year or two down the road. We've talked about this before, Louis, but it's still going on today. It's not getting any better. They're creating rules that are confusing the customer even more. Work with a local professional. And like I said, if you don't know where to start, try to find maybe a local real estate agent that works with a local lender that they can recommend, that they've closed deals very quickly. They haven't had the fallout. And you'll hear all the time out there, Louis, that many agents say, oh, I don't want to work with that bank. I don't want to work with that bank. Why would they say that? They say that because they've had bad experience, right? They've had deals fall through, or they've taken 60 to 90 days to get a loan closed, versus a local lender that can turn something around in 2 to 3 weeks, right? And it's merely, a byproduct of, it's just a completely different model. But that's enough on the rant about that. If anybody does have any questions in regards to, starting the pre-approval process, where they can go to search, please reach out to us. You can go right to the website, realestate360live.com. On the Ask a Question button, I'd be glad to, to try to point you in the right direction of some places you can start. But at the end of the day, just start your search a year to two earlier than when you really plan to buy. It's just a smarter decision, and you'll thank me later, I promise you. We're up on the end of the show here, Louis, but I want to thank you again for coming on.
Thanks for having me.
We will be sure to monitor the Fed and the meeting on Wednesday. And next week, I'm sure we'll have some great topics to talk about after Janet Yellen.
Look forward to that. Yep.
Crossed out on her white horse. Until then, if you give our listeners your blog so they can check that out.
Sure. Smallgold.com. Please check it out. Finance, real estate, economics, gold and silver analysis, 3 or 4 times a week. So please check it out. Smallgold.com. Thanks, Ryan. Thanks, everyone. See you next week.
Thanks, guys. Take care. Don't forget to subscribe to the podcast on iTunes. And also, if you have any questions, realestate360live.com. Take care. Until next time.